Live from the back of Ruth the Realtor's car, it's the Stacking Deeds Show. I'm Ruth's part-time mechanic, neighbor Doug, and welcome to your weekly drive through the wonderful world of real estate investing. On today's show, taxes. Yeah, it's probably too late for this year's return. Please don't tell me you're still working on your 1040. But while it's on your mind, we welcome real estate tax expert Natalie Kolodij. But that's not all. In our headline segment, there may be big problems with office and commercial real estate. Should you stay away? Is there an opportunity? We'll bring ideas. Plus, the phone in the back of Ruth's stretched down car will hopefully ring with a question, and then I'll share some iconic real estate trivia. And now, three hosts who will help you owe a lot in taxes because they're helping you make so much money. It's Crystal Hammond, Alan Corey, and Joe Saul-Sehy.
All right, thanks for that intro, Doug. It's Condo Crystal here in the Twitter streets. And next to me, I have my also high tax paying buddy. To my right in the stretched Lincoln Town Car, it's Alan Corey.
Hello, Alan Corey at Real Estate Maxi. And no, I'm not high tax paying because that means that I haven't bought enough real estate. I got to go get more real estate, which we'll learn today, because then you have the tax write-offs. That makes you be one of those people who cannot pay taxes, that, you know, the rich people that everyone hates, right? Like, how do they get away without paying taxes?
Yes.
That's what we're going to learn today. So I love episodes like this, even though I find taxes boring for sure.
Ooh, and then next to you, or is he next to me? This is a very roomy seat. We've got Joe Saul-Sehy. How are you, Joe?
I'm fantastic. And I got to say, I think taxes are fun. Alan, taxes are fun, dude. They're a good time.
Okay, well, you can do my taxes then. How about that?
Well, I do mine. It's almost like watching the, some people refer to it as the casino. When you're putting your numbers in, you're like, ooh, this is my refund. Every time you enter stuff, your number goes up and up and up, depending on, you know, how well you're doing your taxes.
I think Alan makes a good point, though. Knowing your taxes and knowing how your taxes work, not just handing them off to somebody, is a great idea, which is why I'm so excited for today's episode. We've got that. We also have our headlines. So, guys, let's get into it.
Let's do it.
Hello, chaps. And now our Stacking Deeds headlines. Cheerio and pip pip.
Our headline today comes to us from the Commercial Observer. This is written by Greg Cornfield. U.S. office sales and prices keep falling with declining demand and ongoing distress. We're seeing this headline all over the place, guys, that office workers, not a shock to anybody, not coming back. And I think, Crystal, for anybody who works in office space, America, Canada, Mexico, wherever, if you own that space, it might be troubling.
Oh, I'm definitely seeing that because during the pandemic, you know, a lot of people, they moved away. They were told they couldn't telework. So now we're in the age of telework. So people are saying, I want to live where I want to live. I don't want to live in any congested areas. Since people are not coming back to work, these office spaces are sitting empty. So what are the office space owners to do? They need to start thinking outside of the box, I would say, or it's going to sit empty.
Well, and I would think, Alan, just no matter who you are, I mean, whether you own office space or own a different type of property, like thinking about different uses for your property, how the next step's going to go. If the current tenant doesn't work out, what am I going to do next? I feel like being proactive like that could be very helpful.
Oh, it's absolutely necessary. That's sort of the double-edged sword of commercial real estate is you can have that tenant that stays for 20, 30 years, and there's usually built-in rental hikes year to year. However, it can also be vacant for many, many years, depending on the demands and the needs of that market and the economy at that time. So repurposing commercial space, that would be an excellent pivot. It's also not an easy process, especially if rezoning is going to be involved.
I look at this problem with office space, maybe the same problem as we saw with malls across mid-sized cities in America, like the town where my parents lived for a long time, Mansfield, Ohio. Their mall has been completely repurposed, and now I think half of it now is a medical center. You've got malls and other places where they've turned it into mixed use, industrial, other malls where they've changed it into apartment living inside the mall. So now, you live right down from the Annie's Pretzels or
That's funny.
it's
In
called.
college, I used to drive to Mansfield.
The sort of evergreen businesses, maybe to consider if you want to get into commercial, or service-based businesses, salons, nail salons, hair salons, anything where it's like people centered. And that's sort of an evergreen field. But I've seen a lot of these being repurposed to ghost kitchens or
Yeah.
packaging for online, where it's just a warehouse just to ship things out.
Yep.
That's some of the repurposing that I'm seeing happening right now.
Crystal, why were you driving to Mansfield, by the way? I can't let that comment go. Because
Shopping, but the mall obviously is no longer there, but it was 100% for shopping. But you are right about the repurposing, because I've seen condos built out of an old school before, and the condos were really, really nice.
I've seen churches turned into apartments as well. A lot of these large spaces, because we do have a housing shortage.
Yeah, when I was just speaking of church, I was at a boarded up church at the Economy Conference recently that they'd repurposed into a microbrewery in Cincinnati.
Whoa.
It was just a beautiful Taft's Ale House, just a gorgeous microbrewery that had been boarded up, space, something else. On the note of thinking creatively, this is from CBSnews.com from CBS Los Angeles. South Los Angeles Costco looks to build 800 apartments on top of its warehouse. Alan, I think you found this. This is pretty interesting. Costco bringing apartment-style living to Costco. So now I can shop at the $300 store, get my pallet of ketchup, and just bring it upstairs to my apartment.
That's exactly true. I mean, I do like that 200 of the units are low-income housing, which is desperately needed. What I don't like, and which I don't know yet, is this sort of, do they give preferential housing to Costco employees? And the reason I don't like that is I just don't like everyone so attached to their employer, where their housing, their job, their income, and then typically a lot of these situations you end up getting discounts if you shop within that company's pantry, if you will. And so it's almost putting all your eggs in one basket. So if there's some sort of separation of church and state here, I'm all for it. That would just be my only sort of wrinkle. But yeah, if housing on top of Costco, I would probably go eat their $1 hot dogs every single day, no doubt.
Alan, I was thinking about saving money. Yeah.
I used to work at Target. I could see myself living above a Target, but I also would, when I was in college, I used to spend almost my whole paychecks in Target because of that discount. So I could definitely see how that relationship can go sour after you lose your job if you're an employee of Costco and you live above Costco.
If this works for Costco, though, it also can work for the average Dieter out there, guys. How about this headline from Business Insider? Kelsey Neubauer wrote this. We're building a tiny home village to help solve our worker shortage. So, Alan, Costco, maybe, like you said, we don't know, building these apartments above the Costco, maybe the workers can work there. We have a couple here that built a tiny home village to help solve their own worker shortage. Maggie and John Randolph are building affordable housing in their southern New Hampshire community. Began as a way to provide housing and childcare to employees at their long-term care facility. So people that work at the facility can get housing directly from the people that own that. I would imagine you don't like this either then.
I like that it's a small business, but I don't like that it's, again, you're really relying on the success of this business, right? They're providing your housing, they're providing your income, and it seems like legit, business, real estate, senior housing, and they're obviously in need, and they have a housing shortage. It's very creative. I give them that, but to me, it just feels risky.
This is a real estate show, not a business ownership show. But I do think that making it easier for your employees, if that truly is what Costco's trying to do and what the Randolphs here are trying to do, is make life easier for their employees, I think that makes a lot of sense. I'm with you. If I'm an employee and they're making it super easy, like we've all heard about Google headquarters, right? Where they've got childcare on site, you get free meals. Well, they're not really doing that, quote, for free. They're doing that so you'll work 24/7.
That's true.
On their stuff. But if I'm a business owner, if I'm Google, I think that makes a lot of sense. If I'm a real estate developer, though, developing real estate close to where people are going to work, though, Crystal. That makes a bunch of sense to me. Does it make sense to you that if you're going to do a new build close to where the new Amazon facility is going to go, where a new factory is going to go in, where there's going to be some new enterprises going up?
Well, as a person who lives 500 steps from her job, I am all for that because not only is it building community around the office space, I believe that it's giving the employees, I guess you are right, though. It's giving employees an anchor to work because just like these other places, we have a gym, we have a cafeteria, we have a daycare center and a doctor. We have our own doctors. So I don't know if it's a way to get you to work more. However, the stress that is saved by not sitting and commuting every day has definitely been a life improvement.
Well, I'm all for urban density. I think that makes for vibrant neighborhoods, walkability. It's just if that entire neighborhood is owned by one parent company, it feels a little manufactured and just a cog in the machine.
And that's the question here, Alan, is if I'm the average deeder and I know that there's this new facility going up and I want to maybe try to buy some property there, are the big, huge real estate firms going to squeeze me out of that? Like, am I going to, if Amazon has a brand new facility going up in Texarkana, Texas, let's say, hypothetically, this town nobody's heard of, right? If an Amazon facility goes there, do I find too much that I'm competing against the bajillion pound gorillas and I shouldn't even look at that?
No, I think you want to buy as much real estate as possible in that situation, especially if you have insider info, because that jobs coming to a town is going to create demand and housing demand, and salaries are going to go up. Families are going to stick around. So that is a boon for any real estate investor, is when a large company comes to town, just buy adjacent real estate and get sort of the spinoff workers, the ones who don't completely buy into that company's headquarters and grand vision.
This also speaks to the importance of letting people know your goals, because everyone will know after listening to the show, hey, Joe likes to hang out in boarded up churches. So all of the churches, they'll know, hey, talk to Joe. Talk to Joe if you want to sell, because, he's into real estate and he's a little guy in our neighborhood and he's going to look out for us, and they may choose you to sell to over some big, business conglomerate also.
Nothing like drinking beer in a boarded up church. Not boarded up anymore. Taft's Ale House is gorgeous, by the way. Everybody, if you go through Cincinnati, go eat there and have a beer. It's fantastic.
Pittsburgh's got one too. I've been to a church turned brewery. It's great.
I've been to that one too, Alan. That place is cool as well.
Confirmation.
Yes.
Yeah.
You talked earlier about zoning in the case of this Costco, and I'm sure in the case of this couple in Durham, North Carolina, zoning may be an issue. If I own office real estate right now, or I'm thinking that, you know what, I can take this office real estate and change it. Alan, talk for a second about the difficulty of getting zoning changed, because in the case of these malls that we've talked about, they had to change the zoning, right? The city's like, if we're going to save this and make it actually usable space and not just an eyesore, we've got to do something. So the city might be behind you, or is it ugly enough that I should let that go?
Well, typically you wouldn't purchase something without that zoning and process. So a lot of times you put an LOI or letter of intent or get something under contract that says,
sure,
hey, we'll buy this property at this price if we get the approved zoning. And that zoning period could be a year or two. But if you present a plan that says, hey, we've tried office and it didn't work, and this is vacant, and vacant property doesn't benefit any city, why don't we repurpose it? And here's data that says we have a housing shortage. Here's data that says we need more affordable housing. Here's data, you just prove it with data that we've tried this zoning, trends have changed. This will help the city. That's the sales pitch that you have to give to the zoning board. And it takes a team. It takes a lot of time, but yeah, there's big money when you can make that pivot and repurpose a property, and usually it revitalizes an area.
But going through that process versus another opportunity, I only have so much money. Am I doing that opportunity, or am I taking advantage of an easier opportunity?
If you're a new guy, you're not doing this. This is for the skilled veterans. It's some people, this is their niche of rezoning properties. So I would say stay away from this if this is sort of going to be a new venture for you, because you're wrapping up your money for a long time and there's no guarantee that it's actually going to get approved.
Doesn't this speak to one of what area did this fall in on our bracket, where if you wanted to join a group of people that were doing this already? Is that the active syndication? No.
It can be an active syndication. That's basically any large project. You can invest in these sort of projects. It's one of many flavors.
This would just be the commercial real estate bracket, right? Or the commercial real estate of our top 16.
Yeah, but if you didn't want to touch it by yourself and you just want to partner with people who, like you said, know it, do it.
It's basically one of those things, like if you were going to raise money to do this, no one's going to give you money unless you had a team that have done this before.
Mm-hmm.
Yeah. I love that takeaway that if you're going to do this, maybe just buy into a REIT. Maybe that's it.
I would say residential real estate, houses and townhomes and stuff, that's for the newbie. Leave the commercial real estate, the big things, to people who do this full time.
We will have links to all of the pieces we discussed in our show notes. Make sure you sign up to get them delivered to your inbox for free whenever we release a new show. Today is tax day, and we have a special guest, Natalie Kolodij. She is actually a real estate investor like ourselves and like you listening, and she also specializes in tax preparation for real estate investors. But before we get to Natalie, I believe Doug has some trivia for us.
Hey there, Deeders. I'm Ruth's Fetch It Boy and part-time mechanic Doug. And I'm here with today's quite proper property pop quiz. Pay attention, chaps. This question shall represent my magnum opus. It's that amazingly huge. All right, enough of the English accent. I can't keep that going. On this day, in April 1968, American oilman Robert McCullough forked over $2.5 million buckaroos to purchase what iconic piece of British infrastructure once labeled the world's largest and most expensive antique? And why don't I throw in a free quick hint? Mr. McCullough's plan? He wanted to repurpose it as a tourist attraction for a new city he was building in Arizona. I'll be back with the answer after I get to finishing my plans on making plans. Big plans. Now, not thinking big enough, that's my folly for sure. You can always plan on that. Toodle pip, or whatever the hell they say over there.
Big news. We've partnered with Steadily Landlord Insurance, America's best-rated landlord insurance provider. Discover why landlords nationwide are choosing Steadily for their insurance coverage. Get a quote online in minutes at stackingdeeds.steadilypartner.com. We'll also put a link to that in our show notes. Steadily was founded by landlords for landlords and specialize in landlord insurance. They've made their mission to be the absolute best provider in the market for dwelling, umbrella, builder's risk, renter's insurance, and more. Go to stackingdeeds.steadilypartner for your white glove insurance needs.
Hey there, Deeders. I'm part-time plan maker and full-time procrastinator, Ruth's mechanic and fetch it boy, neighbor Doug. So here was today's question. In 1968, what British infrastructure was purchased and repurposed by American Robert McCullough? Well, as the British landmark was falling down and not fit for modern car traffic, the City of London agreed to sell a piece of history to old Bobby for $2.5 million. But what was the landmark? Well, Robert spent an additional $5 million to ship and reassemble it in his new venture called Lake Havasu City, Arizona, which some referred to as a super gimmick and McCullough's folly. But it looks like Robert won. It is now the second biggest tourist attraction in Arizona after the Grand Canyon. Wait, he owns that too? Anyway, so what was the famous landmark? I'm getting to it. He bought the London Bridge. Did you get it right? Congrats! Here's the deed to the Brooklyn Bridge. You know, I can't wait till I have money to burn like this when I was building Doug City. How much do you think Stonehenge would cost? Or like Buckingham Palace? Wait, would I get a discount like if I bundled them together? Looks like I'm going to need a good tax strategy, so let's say hello to real estate expert Natalie Kolodij so we can do our taxes the right way. Alan?
Hey, Natalie, good to see you. Come on in.
Perfect. Thanks for swinging by to pick me up.
Not a problem. Feel free to buckle up. Ruth is a untrustworthy driver, I should say. I'm excited to have you today and picking your brain because today is tax day. Everyone knows, well, I should say, I don't know if everyone knows, but most people hate really, really rich people because they don't pay any taxes, mostly due to real estate. Is that an accurate statement?
That is a pretty accurate statement. Our tax code is absolutely set up for people who are self employed and especially for those investing in real estate. So it's one of the best ways to pay next to no taxes.
So let's dig in. I love that you're an investor and also an EA and tax strategist. What should someone be looking for if they're thinking about buying their first real estate property or they're doing their taxes and maybe they have one or two properties or just inherited something?
So, if they're looking at their tax return, there's a few things that you really want to know about before you jump into everything. So, the first year you go to file your real estate taxes, everyone hears this, right? Real estate gets you all these tax benefits. And then some people might be a little surprised when they don't save any money that first year with a rental. So, the first thing that you're going to want to look at today, right now, is pull up your 2022 tax return and look at line 11, your adjusted gross income. So, we're going to want to look at that because if your adjusted gross income is too high, then even if your rentals have a loss for the year, you might not be able to deduct it against your other income sources. These are called the passive loss rules. Basically, what it says is your rentals, they're already taxed preferentially. So on your rental income, you don't pay any of those payroll taxes, all those nasty little taxes that come out of all of your paychecks. If your rental has income, it doesn't have to pay any of that. They're passive, so you don't pay those Social Security, Medicare, and all of that. The trade-off, though, is if your adjusted gross income, so if line 11 is over $150,000, then you don't qualify for this small taxpayer exclusion that says you can write off $25,000 of rental losses against your W-2 income. But those losses don't disappear. They roll forward to the next year. There's other ways to use them, but you just don't want a nasty surprise of your income not being reduced by all that money you put into your brand new rental if your income's too high. So that's one of the first things you'll want to know about and where you'll want to look first.
Okay, let me jump in here because I should admit that taxes make my eyes roll back in my head and I completely triggers my ADHD. This is not something I love and enjoy, but I can understand that you do and you're passionate. So a passive loss, is it FICA, the taxes that are not paid, the insurance, the Medicare stuff? Is that what you mean?
There's different types of income and they're taxed differently, right? So like capital gains, if you sell stock or things, they're taxed at a lower rate. The W-2 income, the income you earn working your 9 to 5 job, is actually taxed the highest, basically. You pay income taxes on it, you pay state income tax, and then you pay payroll or self-employment taxes, which is Social Security, Medicare, FICA. So you need to earn more to put the same amount of money in your pocket as you would from your rental. Rentals are passive income, and passive incomes only pay that income tax. They don't pay any of those other payroll taxes. But passive income, there's limits on when you get to use losses it creates because they're already giving you a benefit. The government doesn't like to give us too many freebies. So they basically say, we're already letting you not pay this extra tax. So if you have a loss, we're not going to also let you always use that. We're going to put these rules in place. Maybe this will be kind of a good example to help keep your eyes from glazing over too much with passive losses, because I think a lot of people do. But my favorite way to explain them is, I don't know if you ever played Super Mario back when we had Super Nintendos, but if you already had the raccoon tail and then you got the little star, you couldn't have both at the same time. So it just stayed in that box at the top of your screen until you were in a case where you could use it. Then you got bit by a Koopa. Now you could use your star. Your passive losses, even if that income's too high and you can't use them this year, they're just going to hang out till you're in a situation when you can use them, but it's not always exactly at that point. But just like the star, it'll be there to help you eventually.
I love it. So if I have to recap what you're saying, it's rental income, not as many taxes are taken out as working a day job. If my rental income is a loss, I can apply that to what I'm making in my full-time income to reduce that income a little bit lower.
Yeah, as long as your adjusted gross income, that line 11 of your 1040, as long as that's under $100,000, then you can take up to $25,000 of losses from your rentals every year. So that's huge. That's awesome. But if your income's above that amount, if you get above 150, you can't anymore. They don't let you deduct that $25,000, but they don't go away. So you're going to get to use it at some point. And if you're under $100,000 of line 11 AGI income, you can reduce your W 2 income by $25,000 each year.
And so I know people are listening and saying, why would I invest in real estate and have a loss? That must mean that I'm a terrible real estate investor.
Well, I'm not here to clarify if you are or not. That is that is between you, you and your investments. But with real estate, with rentals, we get something called paper losses. Please don't go buy properties to lose money on. Like that is not the goal. That's not what we're trying to do. On a rental, you get to do something called depreciate it. And basically, this is the IRS's way of saying this asset should make you money across a bunch of years. So we're going to let you write off some of its value each year across a bunch of years. But that depreciation expense didn't actually cost you any money during the year, right? Like most people, some of us buy rentals in cash, but typically you have a loan on it. So you might have only put down a little bit of money against the full purchase price, but each year you're getting to write off part of that full purchase price. So what this means is it's not an actual cash outflow, right? To get to deduct like your landscaping, you had to write a check to the gardener. To deduct your insurance, you had to write a check to the insurance company. Depreciation, you don't. So what you often end up with rentals is at the end of the year, if you take your all of your rents received and you deduct all of the costs you actually had to write a check for, what's left, let's say what's left is $3,000, meaning you literally have $3,000 in the bank. You're stoked. You love owning rentals. Great first year. But then because of this depreciation write off, which is only on paper, didn't cost you any money, if your annual depreciation is $5,000, this means now what happened is you made 3 grand more than you would have without the rentals. But to the IRS, you actually have an extra $2,000 loss instead. So there's a lot of rentals where you are cash flow positive, but for taxes, you show a loss. And this is really common and it's the perfect kind of sweet spot to end up in. There's not a lot of ways you can make more money and essentially be taxed on less than you started with, but rentals are the way.
Yeah, and I think it's important to distinguish that depreciation is not the exact opposite of appreciation. Appreciation means the value of your property. You bought it for 200,000, it appreciates to 300,000. If that drops in price from 300 back to 200, that is not depreciation in the eyes of a tax attorney.
Yeah. Excellent point. So, this is tax jargon depreciation, which is a whole different arena. It's just the IRS's fancy word they use saying that if you buy something that's going to last a long time, in theory, it should wear out over time. We know that doesn't typically happen with real estate, it typically goes up in value. But to the IRS, the laws are the law. A better way to think of it would be like a car. A car typically wears out over time. Not the same as like your appreciation as in the actual value of the property. This is just for tax purposes.
And how many years for a residential rental does it get to be depreciated?
Yeah, for a residential rental property, it's 27 and a half years. So it's just your starting price that you paid for with all the costs it took, and you back out land, and then it's 1/27 of that basically every year.
27 and a half years. That's amazing. Yes, you take that purchase price, take out the cost of the land, divide that by 27 and a half, and that's typically the depreciation you get to claim each year on your taxes. And if that number is larger than what you're making in cash flow, then you look like a terrible investor. Did I get that right?
Yeah, but in the good way. You look
Yes.
terrible just to the IRS. And the
Yes.
best part of this is you don't look terrible to your lenders because they know what's going on. They know about that. So they're going to add that back when they're qualifying you for a loan. So you look terrible on paper, you look terrible to the IRS, which is great, but you still look awesome to your lenders as long as you're actually cash flowing on your property.
And you look great in your bank account too by doing it this way.
Yep, to all your friends who told you were crazy for from getting properties. Yep.
All right. So, what else should we be looking at in our tax returns for us that are doing it last minute and trying to get it to the post office before it closes today?
Yeah, absolutely. So the other things that you'll want to look at on your tax return, a big one is what we were just talking about, your depreciation schedule. If you have your taxes done by someone or you do it yourself on TurboTax this first year when you set up that depreciation amount, it's going to give you a schedule. And this is just the basically the tracking sheet for that amount that we're going to split across those 27 years. So you just want to make sure every amount is included there. If you bought the rental for $100,000, but the amount on that schedule is $100,000, you probably paid some other costs, like you paid a closing cost, you paid realtors, you paid some title fees. So look for things like that. If you know that you also put in some other costs of the property, maybe you renovated it after you bought it, you put in new flooring, make sure costs like that are on there. So looking at that depreciation schedule is huge because that's how you get this sweet spot of tax write off. So you want to just always look at that and be mindful of it year to year. And if you know you spend money on something and you don't see it on there, double check, find out why. Maybe it's somewhere else on your return, but any big renovation should be on that schedule. As a starting point, make sure that your land value is backed out. That's a big one we see missed a lot. Then it costs money to fix later. So always separate out your land value from what you paid and then set up your depreciation. Check that schedule each year, make sure there's no errors. Huge spot.
Yeah, and I think the way to look at this is that land's not going to deteriorate, really. I mean, there's no wear and tear. You can always just build a new building on there, but everything that's above the land, the building, the structure, the siding, that's going to be replaced and that's going to depreciate. So the value of land, it's a guesstimate. No one really knows. You can go figure it out, but I think it's usually around 15 to 20% of the purchase price. Is that sort of how you calculate
You
it?
know, it varies so much county to county and like location to location. So the easiest way to figure this out is to go to your county tax assessor website and just look at the numbers they use. So if they have a split of, 80/20, then you should put the same percentage split on what you actually paid. Because there's some places when I was in Seattle, we'd have some properties where most of the value was the land. So those, big cities tend to be that way. So always check your county assessor website. It's not a bad idea to check it out before you close on something too. Just gives you a good idea of what you expect to be able to write off and how the county is kind of looking at the property.
I love this. And this is nothing special for full-time real estate investors. It's just anyone who owns a property.
Yep, absolutely. And actually you have to depreciate it. Don't try to skip this. You'll hear some people talk about, "Oh, well, I don't want to pay it back later. I'm just not going to do it." It's not optional. So you always want to do this. Make sure you sit down and figure it out early on because it always costs more to fix something later than to do it right the first time. So if you're looking at your return that you're about to put in the mail and you're like, "I just don't know if I did this the right way," file an extension on your taxes. Get yourself a little more time and double check before you submit.
All right, real quick, explain why you would have to pay this later.
With most things, it always costs more to fix something than it does to do it right the first time. A great example is I personally just learned that you are supposed to service a tankless hot water heater more frequently than a normal one. And I learned that by paying a plumber more because now it was a repair because I didn't know the right way to do it the first time. Same with your taxes. If we're doing something from the start, or if you're doing it from the start, that's always going to take less time than kind of unraveling something and then fixing the damage that's been caused. So it's always a little better to take a little more time or spend a little money up front than to try to go backwards and fix a bunch of things.
This is great info, Natalie. Is there one other thing that we should look for, us real estate or investors, on the tax returns?
Yeah, I would say the other big thing to look for on your tax return, if you're brand new, you won't have this yet, but we talked about those losses and how if you can't use your passive loss this year, it carries to the next year. You'll have a statement on your tax return called a passive loss worksheet or a passive loss carryover worksheet. Always check those year to year because this is like your piggy bank for losses, right? You want to accumulate those build up. But if you switch software or you go to a new tax person, it's really easy to kind of lose track of those if they don't spot that worksheet. So always look for that because if you know, hey, I've owned a rental for 3 years and I had $10,000 of losses each year that I couldn't write off, you have $30,000 of basically banked up deductions that you'll get to use at some point. And if you don't see that on your new return, maybe you switch software, you want to go back and grab that because you don't want to lose track of those. So always check your passive loss worksheet and just make sure it lines up with kind of what you've had year to year. You just don't want to lose track of them because if you lose them across time, then when you go to like sell the property or in a year when you have some taxable income where you can use the losses, they won't be there. So always check that passive loss schedule.
I love this. And before I let you go, I want to dig in about the bonus depreciation. How does that work? Because I keep hearing this phrase, and it's a way to actually deduct even more money from your taxes.
Yeah, so this is one of those kind of hype words right now. You're right, we do hear it everywhere. So bonus depreciation, like we talked about on a house, you get 1/27th, right? Each year, the value of the house, you get to write it across 27 years. Bonus depreciation, it only applies to assets with a life of less than 20 years. So a house starting doesn't qualify. But if you do a cost segregation, which is where someone breaks out all the parts of your house, like assigns a value to your floors and your windows and appliances, a lot of these things that make up a house actually have shorter lives than that 27-year mark. So, what bonus depreciation lets you do then is if we've separated out, say, $30,000 worth of a $100,000 house into these shorter lives, they qualify for that bonus depreciation, which is just fancy tax jargon, fancy way of saying you can write off a big chunk the first year. For 2018 through 2022, that was 100%. So, of that like $30,000 hypothetical amount, you would get to write off the whole thing. For this year, it's 80%, which is still a huge chunk. So, it just gives you a bigger loss. So, this is important. It gives you a bigger loss. Whether you can use it or not still depends on that line 11 of that first page of your 1040. So, before you go pay a bunch of money for a cost segregation to create a big loss to try to use bonus depreciation, check your tax return, make sure your adjusted gross income isn't over 150,000 first, or the losses from your long-term rentals. If you create more of them, you've just created more of something you can't use. So double check that first.
This is wonderful information, Natalie. Where can people, who have these questions, how can they reach out to you?
Yeah, absolutely. So you can always email me. My website is kolotax.com, but Instagram's probably the best place to follow me, or YouTube. And I'm RE Tax Strategist on Instagram. There's just underscores between those. And it's a great place to submit questions. I love doing those live events and posting questions on there. So reach out with any questions there and follow at Real Estate Tax Strategist on YouTube for just general tax information broken down in people terms, not tax, not accountanese. So hopefully I can explain it in a way that is sensible.
I appreciate it. That's what I need. I love real estate. I'm passionate about it, but it's the tax part where I really have to focus. So it's people like you that save my butt and make my pocketbook bigger. So I appreciate it.
Perfect.
Well, it looks like actually Ruth's pulling up to the post office right now. I'm going to jump out, review my taxes before I hit send. Thanks for joining us in the ride today.
Perfect. Thanks. I'm going to go ahead and have Ruth drop me off at the airport for a little vacation after tax season, and I appreciate the ride.
Thanks for joining us, Natalie. What a great conversation about taxes. Always plan ahead, because if you're trying to hire someone to do your taxes today, you're out of luck. Or if that person is available, they're probably a terrible tax person. What do you think, Alan?
Just like a contractor, someone who can start right away, there's a reason they don't have business. But I've been that guy who does his taxes on the last day before. So no shame in that game. It happens. Sometimes the tax day sneaks up with you, but great info from Natalie. And you can find more information in our show notes, stackingdeeds.net/show notes. We'll email those to you. Sign up today.
That's the phone ringing.
It is, which means it's the last segment of the day, ringing Ruth's Rotary. A question from the audience today. It looks like, wow, this is a text message?
It looks like Ruth got a brand new track phone. All right, she's handing me her phone. Let's see what it says. Okay, so today's question comes to us from Andrew Haber. Thanks, Andrew, for the question. He says, I was gifted a multifamily 4-unit apartment that has had great appreciation over the years. And since it was gifted, there is no step up in basis, and the capital gains will be close to $1 million. Congrats, Andrew. I'm looking at options and no longer want to be an active landlord. Plan on doing a 1031 exchange and want your opinion on Delaware statutory trusts. Thanks. Alan, this is all you.
No problem. Let me explain some of the language in here. First of all, step up in basis. So basically, if you buy a property, real estate, it's what you purchased it for, how much money you put into it. And then when you sell it, it's that delta between what you sold something for, what you bought it for, and how much money you put into it. Because it's an investment and you put some money into it to increase the value. And so the basis is sort of that bottom line. If you gift something to someone, it's what that original person bought it for, not what the value was when you received that gift. So A step-up basis would be, hey, I gifted you $1 million. It's worth $1 million. If you go sell it for $1 million, you pay no taxes because you got something for $1 million, you sold it for $1 million. Maybe we don't know the exact numbers, but maybe the person bought it for $500,000, gifted him $1 million apartment. But if you were to pay taxes, it would be $500,000 would be what, quote unquote, he bought it for, and he would be taxed appropriately. But I guess it would be $1 million spread in his case. So he's paying about $300,000 roughly with the 30% tax hit on this. And there's definitely reasons why you'd want to save and maybe circumvent this property. The problem seems to be Andrew doesn't want to be an active landlord. I think there's multiple ways to solve this problem. One would be get a property manager that would only take 10% of your rental income on average of this property and manage it. That would be one way. A 1031 exchange is a tax vehicle that basically says if I sell one property and buy other real estate property, as long as it's worth the same or more, I don't have to pay taxes yet. It's snowballed. It's deferred into a future date. That's a very common vehicle here. So Andrew, it's almost like a 5-part question with a lot of like lingo here. Last one is the Delaware Statutory Trust. This is another vehicle to invest in a syndication, if you will, basically a portfolio, a company's portfolio of properties, and you would have a fractional ownership. So he could sell this property for $1 million, defer the taxes, and then he buys into a fractional share of a company that has a portfolio of properties. That way he's hands-off landlord. He has no decision-making to do. And that solves the problem of wanting to be very, very passive here. The cons of this situation would be he loses complete control. He can't easily get out of that situation. All of his trust now is into this company and their portfolio of handling the deal. That's the risk reward of all investing. There's always going to be pros and cons. So Andrew, it's up to you. If you want to do this, this is a common method. And the fact that you've asked this question tells me that you've done some research in this area already. And I would say go for it if this is what you want. But first, look into just having a property managed to manage this property, because I have property managers for over 300 units and it doesn't take any of my time, maybe 15 minutes a month of reading an email or answering to an email. So this is very common as well. And then you can have control if you do want to sell it, if you want to 1031 later into another property or into another Delaware statutory trust. It's very, very complicated stuff. Or maybe reach out to our guest today, Natalie at Kolodij Tax, because she's going to be the tax expert, not me. As I've already said in the interview, this is not my expertise, but it is something that many real estate investors use. Does that make sense to you, Crystal?
Oh, that definitely makes sense. I knew Alan was going to recommend not selling and just getting a property manager, but that is true because with a property manager, it is like you set it and forget it. You know, your property manager manages all the headaches that come with active landlording. Sometimes there are, sometimes there aren't any headaches. So I love Alan's advice. Thank you so much for calling in, Andrew. And if you have a question for Alan and I to answer, head on over to stackingdeeds.net/voicemail. Leave us a message and we will answer your question just like we did Andrew's today. So it looks like that's a wrap. What a great show today. What was your favorite part, Alan?
Well, I love talking commercial real estate, the office rezoning. To me, that's fun and creative. It's difficult, but it's just a sort of brainstorm revitalization of an abandoned mall or a brewery or a church. Those sort of things are fun for me as a creative person.
Yeah, I love taxes. I can talk taxes all day. I do mine. I love doing my taxes, even though I do usually file an extension. So I give myself free time, but I definitely love talking taxes, and I love all of the advice Natalie gave.
All right. Well, we'll see you next Tuesday. Doug, what should we have learned today?
So, what should we have learned today? First, take some advice from Natalie Kolodij. Knowing just a little about taxes can help you grow your empire much faster. Second, how about this gem from our headlines? With office space in trouble, you need to always think creatively about your properties. Is there a better use or a different way to market your product to keep it in vogue? But the big lesson? Turns out this deed I got to the Brooklyn Bridge, I was going to give to you, maybe, but it's fake. Yeah, my bad. Give our hosts a follow on social media at Condo Crystal and at Real Estate Maxi. Thanks to Natalie Kolodij for joining us today. You can find out more about her work at kolotax.com. That's KOLOTAX.com. Don't worry about it. We'll also include links in our show notes at stackingdeeds.com.